Hello everyone, Professor Christensen here. Today's video is going to be about bank reconciliations. So on your screen you'll see a few things. I have a sample bank reconciliation for you, and then we're going to show how that affects our journal and our ledger. Okay, so let's take a look at this. We'll run through this, look at all the different components, and then we'll do a problem together. Okay? All right, so we have a bank reconciliation for this company as of January 31st. The first thing we start with is balance per bank. All right, what does that mean? So you got a bank statement in the mail, or you got a bank statement online, and your bank statement says your cash account has $15,698 in it. All right, however, your general ledger says you have $20,649. So our goal here is to make sure that when we take into account all the things that the two entities know and don't know, we're going to hopefully come down to the same number. Okay? All right, so what do we need to do? We need to adjust the bank for anything that we know about and that we've put into our account, but that the bank hasn't put in yet. Okay? And then we need to adjust our books for anything that the bank put into our balance here, but that we haven't taken into account yet. All right? So remember that you're going to adjust for what that party doesn't know. All right? So let's look at the bank first. So the bank, we're adding deposits in transit. So what are they? Those are deposits that the company recorded in their ledger and they put into the bank, but they haven't shown up on the bank statement yet. Okay, so we know about it in the company, the bank doesn't know about it, so we're adding it in to our balance per bank. We're going to take a little subtotal, that's just for simplicity, not necessary, and then we're going to subtract outstanding checks. Have you ever known anybody that wrote a check and then it sat around for a little while? So whoever wrote that check, or whoever got the check and held on to it for a little while, the other person had an outstanding check. So what is that? This company wrote checks, mailed them out to people or sent them, but they have not been cashed yet. Okay? So we took them out of our ledger, but they have not cleared the bank yet. All right? So we need to take them out because the bank doesn't know about those checks yet. All right, that brings us down to our adjusted cash balance, okay? Our adjusted balance per bank. All right, now let's go to our general ledger. So we said that this balance comes from our ledger, $22,649. We're going to adjust this for anything that we found out when we got our bank statement that we didn't know about before. So one of the things is the bank collected a note for us. So remember, note receivable is money that somebody owes us. We had a receivable. Instead of sending us the money, they sent the money right to the bank. So the bank put this into our account. We didn't know about it, but now we do. So we're going to add it into our balance. Okay? The bank added it into their balance, but we haven't added it into ours yet. Okay, what else do we have? We have some interest earned. Now, the interest could be interest on the note, or it could just be interest on your checking account, okay? So anytime you earn interest, you didn't know about it until the bank told you that you had earned interest, right? So we have to add that into our ledger account because we didn't know about it. Again, we have a little subtotal here. That's just those three numbers added together. All right, now let's see what we're subtracting. We have an NSF check. What's that? An NSF check, not sufficient funds. So what happened was a customer gave us a check, we recorded it, we put it into the bank, and the customer didn't have enough money in their account to pay for the check. So it bounced, basically. So NSF, not sufficient funds check, that has to get subtracted from our balance. We thought we had that money, but we really don't. Okay? All right, bank service charges. So the bank charges you. The bank could have charged us for the bounce check because they often do. It could just be a monthly service fee. There's a lot of different reasons banks charge service charges. Okay, so that's going to be a common subtraction. And then the last one, we have an EFT, which is an electronic funds transfer for advertising. So that means we paid our advertising. The money was sent directly from our account to the advertising company's account. All right. When you add and subtract, guess what? We have the same number. Excellent. That means we have reconciled. Okay. And we have this new balance, 21,734, which is actually the correct balance that we should have in our books. So what do we need to do? Anything that's down here, any of these adjustments, I shouldn't say anything, any of these adjustments are going to require journal entries. And that's what we have here. So let's look at our first journal entry. We increased our cash or debited it. Remember, cash is an asset, so we increase assets by debiting them. We increased our cash by 1136, which is the total of these two numbers. So that's a debit to cash. We credited notes receivable. Notes receivable is also an asset. The customer doesn't owe us the money anymore, or whoever owed us the money does not owe us the money anymore. So we're reducing our notes receivable by crediting it. And then we're crediting interest revenue. Remember, revenue has a normal credit balance, and we have revenue that we didn't have before. All right, so we're taking this 1136, and then what are we doing? We're posting it to our cash account. Okay, we're posting it to our cash account. So our cash, we're going to increase it by 1136 for those two reasons. Okay. All right, our next journal entry, we're debiting accounts receivable. Why are we debiting accounts receivable? Well, we're debiting accounts receivable for the NSF check. Why? The customer still owes us the money, right? We thought the customer had paid us. We took it out of their receivable, but guess what? They didn't really pay us because the check bounced. Okay, so this customer still owes us $698. We're debiting accounts receivable. We're debiting service charge expense for the $50 the bank charged us, and then we're debiting advertising expense for the $1303 that we paid for advertising. This credit is the three of those things added up. Okay, so we have a credit of 2051. Let's make that blue. That goes here, right? We post that as a credit to our cash. Now our cash balance, remember how T accounts work. Cash has a debit balance. So we're going to take the 22,649. We're going to add 1136, subtract 2051, and we get the number that we are familiar with, 21,734, which is the adjusted balance. So what we said was this is the right balance that should be in our cash account, and now there it is. Okay. By the way, on our balance sheet, under current assets, what are we going to show? Cash 21,734. Okay. All right. So that's the background for bank reconciliations. Now we're going to go and practice one. So let's go over to our demo problem and look and see what's here. Okay, so Donaldo Inc. is our company. We're given our cash balance per bank and a bunch of other information. Now, what I like to do is to go through each of these things and decide where are they going to go on our bank reconciliation. This way we'll have it all organized before we start, especially when you get to bank reconciliations that are more complicated than this, okay? All right, so we know that the cash balance per bank is going to be one of our first lines on our reconciliation. August bank service charge. Now, what do we do with the bank service charge? Remember, the bank knows about that, but we don't know about it. The company's books have not recorded that $80 yet. So this has to be subtracted from the books. Okay? Cash balance per books is going to go down at the bottom. Now, deposits in transit. What do we say about deposits in transit? Well, we said that that was money that we knew about in the company, but the bank didn't know about yet because we put the money in, but the bank hadn't recorded it yet. So that has to get added to the bank. There was a note collected, $4,600 plus interest. The bank knows about the note, but we haven't recorded it yet in our books, so we're going to have to add that to our books. Outstanding checks. Well, remember, outstanding checks, we recorded them on our books, but we have not, the bank does not yet know about them, right? So that means we have to subtract this from the bank balance. And then finally, we have the NSF check. And remember, the NSF check we didn't know about, but the bank did. The bank took it out of our account, so we have to subtract this from our books. Okay? All right, so first thing we're going to do, we're going to put a heading. Name with a 3-part heading on everything. Why? Because somebody's going to be reading this that doesn't know what you did, right? So you need to tell them, what company is this? What statement is this? Bank reconciliation. And what is the date? August 31st. Okay? All right. So I always like to start with the balance per bank because that piece of the bank reconciliation is generally simpler. Let's just go back here 1 second. Almost every bank reconciliation that you run into when you're doing it in college is going to look just like this. Okay? There's not many things that can affect the bank other than these two things unless you have a bank error. And sometimes you do run into a bank error. The bank might have taken something out of your account that should have come out of someone else's account or something like that. So if you had a bank error, then that would also go up here. But generally speaking, if you can memorize this part of your bank reconciliation, you're off to a great start because you have the number here that you have to agree to down there, right? All right, so let's go back. So we're going to have balance per bank, and our balance per bank is equal to 14,656. I like to check things off. I'm going to highlight them here as I go along to make sure that I took care of everything. And you should do the same thing, especially when you're using paper and pencil. Just check things off, or if you're in Excel, make highlights like this. Okay? All right, so we're going to add, what did we say to the bank? Deposits in transit. Add deposits in transit of 5,400. Again, I'm going to highlight that so we know we're done with it. All right, so let's get a little subtotal again. Again, not necessary, but this way we know that we added those two numbers. Okay, now less outstanding checks. This is going to be a minus, right? Minus 1544. All right, so we took care of all the things that we said were going to affect our bank balance. So now we have adjusted bank balance. And that's equal to these two added together. Okay, all right, so our adjusted bank balance is 18,512. That's our goal now. We know what our target is. We want to make sure that down here, our adjusted balance per books comes to the same amount. Okay, all right, so now we have balance per general ledger or per books, whatever you want to call it. Balance per ledger is equal to 14,560. Okay, now what did we say we were going to add to our books? The note. Okay, so add note. And let's add the note plus the interest, right? The 4,600 plus the 32. Again, we'll get a little subtotal. Okay. And then we're going to say less. Whoops, my less is in the wrong place. Less. All right, so the things that we said we were going to subtract: bank service charge and the NSF check. So bank service charge is $80. We did the note, so let's highlight that. And then the last thing we have is NSF check, and that's equal to 600. Okay, so now we have adjusted book balance. So I'm going to sum up the 19,192 and then those two things, two adjustments. Okay, now we're happy. Why? Because we have reconciled. Okay, kind of remind you of a balance sheet a little bit, right? The top and the bottom have to be equal. So we have an adjusted bank balance and we have an adjusted book balance. They're equal. All right, next up, remember we need to adjust for anything down here that affected our books. Okay? We don't have to adjust for what the bank did. The bank is not going to make any adjustments. Eventually those things are going to come through the bank. But we have to adjust for the things that we didn't know about that we found out as a result of our bank statement. So let's start with the things that were increasing cash, and that's the note collected by the bank. So we're going to debit cash, and we're going to debit cash for the $46.32. Okay, because that's how much we increased our cash. Now, what are we crediting? We're crediting notes receivable for $4,600, right? The face value of the note. And then the rest, the 32, interest revenue. Okay, because we earned revenue interest on that note. Okay, so we took care of the increase. Now we have two things that decreased our cash. So we're going to debit service charge expense. This could be a miscellaneous expense also, generally a very small number. Okay, so our service charge expense is $80. And remember, our NSF check means our customer still owes us the money. So we're going to debit accounts receivable, increase our accounts receivable for the $600 that they owe us. Okay, we're going to credit cash or decrease our cash for $680 because that's how much was taken out of our account. All right, now let's take a look at our ledger. So our ledger balance right now has a balance of $14,560. We're going to add $46.32. We're going to subtract $680. So this is equal to our beginning balance plus the $46.32 minus the $680. Remember, credits decrease cash. All right, and our ending balance in cash, $18,512, which is our adjusted balance, and we're happy, right? Our balance in our cash account is what it's supposed to be. If we prepared a balance sheet as of this date, this is the cash amount that you would see on your balance sheet. Okay? All right, well, I hope you find that helpful in your accounting studies. See you in the next video.